right, good morning. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades to reduce our risk and improve the consistency of our performance. Now, why would we have a shared goal like that? Well, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I have my University of Oxford shirt on today. Yay! Actually, and I got that one too. I got them both. Hey, that's nice, man. You got to pair it up. Anyways, my name is Wayne. Been around doing this thing we call trading and investing for a long time. I'm still very excited about it. I like what we do every day. I honestly do. And one of the things I've been thinking about, and it's just stuck on my mind, is somehow I want to start I don't know what to call it, a charitable fund or an income producing fund, but I have a goal in my mind. I don't know how I got this, but if you have a retirement account and you only have $1 million and you're going to retire, wouldn't it be cool if that $1 million gave you $100,000 a year to spend, to live on, but all those stocks are still there in the portfolio? So at the end of the year, you still have $1 million, or actually more would be the goal. Like the goal of the fund is like in an endowment. That's what just hit me, right? Like in an endowment. Your money should be in perpetuity. Your $1 million should be there the day you die, and you give it to your kids and your grandkids. Meanwhile, you live on $100,000 a year. I'm like, dude, 10% is achievable. So anyways, I don't know how I got into that. But anyways, so my wife tells me the only thing I talk about is money. Oh, well, there you go. So that's what I like. I like money. So anyways, very cool. So let me know how it can help on your journey, whether it's Forex or stocks or bonds or futures. We could talk about all of that. Excuse me. Today, I think we'll go through the stock market, and maybe we'll take a quick gander at bond yields. We'll look at, obviously, dollar pairs and maybe some yen pairs. Byrne says, I guess you need a little bit more to cover inflation. Well, maybe. Is that my problem or your problem? Because here's what it comes down to, Byrne, right? I'm like, okay, well, my solution provides 10% a year in income. What does your solution provide? You're like, I can't make the 10% a year. Well, then whatever your bond portfolio is doing, my portfolio can outperform. But yeah, if you have lots of inflation in your country, move. Yeah, burned. But what are you going to do? Look, there's an old saying I learned from Guy Kawasaki. Do you guys know Guy Kawasaki? I was in Red Herring magazine. Do you guys remember the Red Herring magazine? Focused on the Silicon Valley in the 90s. He and I were in a picture together. I have a picture somewhere. Anyways, I remember I was wearing a brown suit and a black tie. Ugh. Anyways, in one of his speeches, he said, when your invention is toilet paper, you don't need 9 plies of paper. You don't need little pillows. It doesn't have to smell like spring flowers. When your customers are wiping their butt with dried leaves, your toilet paper's good enough, bro. Right? So Bernd, look, if your strategy is doing 6 and I'm doing 10 and you're like, but I got inflation. Well, screw you. My 10's better than your 6. So anyways. But the idea is you'd have to produce more for sure. But you have to do it without risk. And that's the most attractive part of it for me. But anyways, so I digress. So, or you digress me. So yeah, dollar pairs, yen pairs, gold, oil, Bitcoin, that kind of stuff. We'll probably talk about the banks, but really, look, you're the boss. I'm a humble currency trader. This is what I do all day, every day and I bore everyone around me. So, if you want to talk money, we're best friends. Okay. So, you know, you can lead on the journey and I will follow. I am a humble servant. Okay. Nice. In the description below the video, there's lots of links. They're all important. One is to my book, Strategic and Tactical Forex Trading. Another one is QuantBox, which is, you know, an algo-driven or AI-driven, if you want to call it that, sitting on the cloud, pulling economic data from all around the world and displaying everything cleanly. It ranks and scores based on economics. That's the interesting thing. It ranks and scores. Very cool. So anyways, you can check that out. Hey, man, the trial is less than $8, but whoa, dude. Okay. So anyways, go check that out. There's a link to FX Bootcamp. That's my live trading community. Everybody starts with the training videos, $88 a year. And then eventually you want to upgrade to like the swing trading group, $99 a month. Okay. There's a link to tradersway.com, a trustworthy, ethical boutique foreign exchange trading firm that would like the opportunity to earn your loyalty and respect. So they're asking, their hands are out like, let's dance. So get off your seat, get to know them. They earn my loyalty and respect, and I recommend them to you. Go check them out, tradersway.com. Start with the demo. Bro, start with the demo. Cool. I just want to show you one of the things I'm working on today is a QuantBox training course. Oh, after all that coffee, holy smokes, does that water taste good? Sorry about that if you had to hear me gurgle on the microphone, but oh, that was so good. Anywho, so I'm going to start with that today. Quickly, we could take a look. Oh, by the way, if you get a thing like this, you're not logged into the correct Gmail account. So I'm going to log into the Gmail account associated with my QuantBox account. Because remember, we're actually right now logging into the Google Cloud. This is not a web page. This is all being dynamically created by the database. Cool. So what I wanted to get to here is the market heat map. This shows us what's moving and what's not. Let me zoom in for you. You're welcome. Okay, 10-year yields are still heading down in a blaze of glory. Oop, this looks like we're having an error pulling information from one of the databases. Just shows it's live. But anyways, 10-year T-note, look at this, -5%. Oil down, right? -3%. Wow. Crazy. Look at this. Kiwi Swissy down. Aussie Swissy down. Swissy yen down. So Swissy strong. Look at pound Swissy down. But yen is even stronger. Aussie yen down. Swissy yen down. CAD yen down. Holy smokes. Oil down. Dow is down. FTSE is down. Oy vey. Holy smokes. So what's up, Duck? Euro stronger than Kiwi. Euro stronger than yen. Euro stronger than Aussie. Euro stronger than pound. Euro stronger than dollar. Euro stronger than CAD. Euro stronger than Swissy. I wonder, is Euro strong today? Now this is updated in real time. You can see, it doesn't display it. Okay, this is real time. So in fact, if I reload, maybe it just had nice. Maybe it had a problem pulling just that one time. Let me see if we can get that S&P. Okay, if it comes up green again, that just means one of the data providers has a glitch in the data, in their in their API. Happens, bro. Let me open up the tab. I want to see one more time. No, it's still okay. That's fine. Cool, right? Don't you stink? Lovely, with your smile so worn and your teeth so green. Hey, I purchased 1 month, but you mean it's not working? Then email me. But most likely, let me tell you something, guys. Let's see if I can address this quickly for everybody. If you log in and you see something like this, you're logged into the wrong Gmail account. Or you didn't sign up. Like, I'm still shocked. There's a lot of people on the sign up screen in giant letters, in bold red letters, it says you have to use a Gmail account. And people put in their Hotmail account or their... So, dude, so now we got to go back and fix that. So that might be your problem. The other thing is you might just be logged into the wrong account. You look, I have 5 accounts I could be logged into. I need to be logged into the right one, which is the QuantBox one, right? So you're able to switch and log in there. Now, if that's not the problem, then you might have an ad blocker or a cookies blocker. And guess what? Now Google can't read the fact that you're using a Gmail account, so it can't authenticate. So you have to turn your blockers off. Okay, guys? So it's one of those 3 problems if it won't log you in. Okay? That's cool. I was messing around with this yesterday. I just noticed the letters turn red. Why would that be important? Anywho, there you go. So great. James asks right away, Wayne, there is a bond hierarchy, correct? Yes. They're in the capital stack. There is a hierarchy. Some people get paid first and they get the least return, and some people get paid last and they get the higher return. Yep. Okay. Yep. It's called waterfall analysis. If you want to Google that, capital stack waterfall, see what you get. Cool. Yes, Johnny. I think so. You might have to refresh, but I don't think you're going to be sitting there staring at it, because it doesn't pull every second, but it updates nearly a lot. It might be every 10 or 15 minutes it updates, or maybe every, but it's not like weekly like the COT data, right? But yeah. But I haven't sat there and stared at it, to be honest with you. Yeah. But it's meant to be something that updates frequently so you can see what's hot right now. So if you listen to, so do I still have the training course? Was it on this page? No. Cool. No, I closed it. Too bad. If you do the case study, How to Trade Like a Floor Trader with Denise, she references an amazing way that she uses the market heat map, and it gave me some ideas for development. So that I can make it easier for Denise to make those decisions. So anyways, cool. Yeah. Yeah. So yeah. Okay. So you're following along, right? Yeah. Yeah. Everyone does it differently, which is really cool. And I know now a lot of people are doing what Lucas explained in his How to Trade Like a Farmer, by dropping watermarks or notes on each chart, bull, bear, QB bull, QB bear, that kind of stuff. Byrne says okay, let's see what. In the QuantBox screen you showed, would it be possible to also put in a weak, neutral, and strong currency pair? Like top buys and top sells? Or being able to rank by trend the most bullish currency pairs versus the most bearish currency pairs? Or the currencies that are and assets that are heavily long, or in this case, retail heavily short, and match them up. Okay. Or are you talking about, oh, yeah, see, this one doesn't. So you have to go to Pro to get features like that, Burned. So if I go to my Pro, okay, I can do this. And it ranks them. Yeah, see, we're not pulling. We got an S&P 500 issue. We'll have to look at that. But yeah, so yeah, almost everything's neutral right now, and lots of selling. Okay. Now you can clean this up, obviously, and just say only major pairs. Or I guess we can get rid of indices and commodities and just do the pairs. Okay, and there's your capital stack. Almost everything is neutral. Sell Kiwi yen, sell Aussie yen, sell CAD yen. Yeah. Anyways. Anywho, whatever. Oh, no, we have it here. Sorry. Brain fart. Anywho, let's move on.com. It's beautiful, huh? It's beautiful. It's beautiful. So anyways, Euro is hot to go. HOTTOGO. Oh! Euro. And holy schnicker-schnocker. Holy schnicker-schnocker. Oh gourd. Oh, gourd. Yeah, holy smokes. The thing is, not that it's doing it, it's that did you know it was going to happen? There's a big difference, right? So like looking at this chart, by the way, we have a projected 21 and an actual 21. They're different. The target based on entry here is you might get to 49. So there's basically 200 pips left in this move, but obviously you're going to be challenged in here. What? I mean, duh. So this would not be a good place to buy, but there's probably 200 pips in the move. Oops, sorry about that. Get that out of the way. Hang on. So the question is, did you know to buy it before? So if we back up here, going back a little bit, here's something that I'm going to introduce. I don't think I've ever spoke about it before. And it's on for pro subscribers of QuantBox, but check this out. So I just bought up EuroCAD, and what it's showing you is on these days where there's blue, where it says 2222, these are like buy, 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 stop buying, sell, 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 sell. These are just literally what QuantBox was telling you. On these days, heavy sell, heavy sell, heavy sell, heavy sell. Okay? And then in here it was buy, 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 buy. Isn't that interesting? So it's like a back tester. So the bars are telling you what QuantBox was saying. Look at this, heavy buy. So QuantBox, let's say yesterday, the day before, 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 even on the drop, the day before, the day before. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There was, it was recognizing that there was bullishness in this. And so even in this drop, it says keep buying, keep being a bull. Remember, it's economically driven. Economically driven. So anyways, so yesterday before this giant rally, that's the point I'm trying to make. Okay? Quantitative analysis of economic data of euro versus CAD, you would have already been in that trade. You wouldn't be staring at it going, oh my God, look how much it's moved. I should buy it. And I'm like, should you buy it up here after it's happened? No, probably not, huh? But wouldn't, right? Looking at it like amazing, if you had been a bull during this whole period, you would already be enjoying that. In fact, you might be thinking of taking profit. So isn't that neat how it scores itself, how well it's been doing over history and over time? Cool. So I'll have to train you on that. But you can go back and see how divergent sentiment is from true economic reality. Most of the time they're similar, but they can diverge. Let me give you an example of the real world. Just to understand the difference. Okay? Have you bought a bank stock, a regional bank stock? Let me put it in a context of the difference between sentiment and sort of economic reality. Okay? This is where market inefficiency exists. Now, in universities, many professors teach that the market is perfectly efficient, which is perfectly stupid. This is a great example of it, where Silicon Valley Bank goes out of business because they were doing bad things with their money, and they had a very, very, very unique business model with a very, very, very unique client base. You couldn't get a more unique bank, and it went out of business. So now all regional banks are on sale for 50, 60, 70, 80% off. All of them? Really? Are they really all the same? Are there additional bad banks? Yes. Are some of the banks more susceptible to bank runs than others? Yes. Are all the other banks the same? No. Some are retail banks, and some are commercial banks, and some are real estate banks, and some are industrial banks. And they serve different client bases with different risk structures and different capital structures, different risk management, different everything. And they all drop by 80%? That sounds like something is wrong. Sounds like something logical isn't happening. So when a good bank gets taken down because the tide has run out and all the ships have gone down, you need to find the ship without the hole in the bottom of the hull. And so, right, it shows that you can have sentiment and reality be completely opposite, or somewhat divergent, very divergent, slightly divergent, or exactly the same. Most of the time they're lined up. Sentiment and market reality is about the same, right? And with QuantBox, you can look at it and remember, an algorithm doesn't have any emotion. It will just calculate the value of Europe, like the quality of the economy in the UK. And then you'll say, hey, QuantBox, how does the UK compare to Canada? Hey, QuantBox, how does the UK compare to the United States? Hey, UK, how does it compare to New Zealand? And it'll tell you. It'll always be correct. And you might find out, ooh, okay, the UK is doing, or let's say Europe is doing way better than the UK. That might be true. But then you open up your charts and you see the opposite. That's sentiment. People might have fear or greed, or there's a behavioral issue where you might want to buy the dog with fleas because it's the cheapest. So now there might be a value play where you want to buy the dirty dog because the other choice has already been bought up and it's expensive. But nonetheless, there's a divergence. The economic data is the economic data. You cannot be wrong in calculating CPI because we get it from a government database. CPI is the CPI. And then you compare the change in CPI over time in that one economy, and then you compare that one economy to all the other economies, and like it will always get the right answer, but it doesn't mean the market's bullish or bearish. And that's the difference in sort of behavioral finance and sentiment and all that. And very often that divergence is the opportunity. So going back, I did buy a regional stock in a bank that has customers, that is well managed, that is profitable. Not only has it been profitable, it's been profitable quarter over quarter over quarter over quarter over quarter. And on top of that, its profit margins are actually growing. and it was down 70%. I look at it like somebody is freaking out. You know what I mean? Somebody's freaking out. And I'm a stoic. So while somebody else is freaking out, the sky's falling, they're peeing their pants, I'm like, you know what? Why don't you sell me your stock? I'll give you 30 cents on the dollar, and you can get out of your ownership of that bank, and I'll take it over. Okay? Okay? Right on, Denise. Yeah. That's my first goal, which is kind of funny because now I have this idea like I want to manage people's retirement accounts. But the reason I started to get this idea, and the reason it started with the charitable fund idea, and I don't know if that's the direction it's going to go, I have to worry about Reg D regulations, but because I don't want it to be institutional only. I want to start like a hedge fund for the average Joe. Remember, the average Joe should have at least $1 million in their retirement account. And if not, well, we got to get there. You need to start sooner than later. But nonetheless, that's the opposite, right? Like here, I teach you how to make your own investment decisions and stuff. But on the flip side, retirement accounts are different, right? And I'm like, well, wouldn't it be cool if I could package and organize, using, blue chips and derivatives and Forex to have this endowment fund, an endowment where the goal is we always have our principal and it pays money. So every year you're taking out 100,000, 10 years later, you have more than $1 million. And you only started with $1 million. You're like, dude, I pulled out $1 million. 10 years later, I got more than $1 million. So now you're making 12 grand a month instead of 10. Like that would be the goal, right? But, meanwhile, you're still doing your Forex trading. Angel says, would you say there's blood in the street? Well, for banks, maybe. But no, I think they're depending on what the Fed does tomorrow, it'll defer. So I might have to update my model that I described 3 months ago. 3 months ago, I said the blood in the street, Angel, would be in sort of the September-October period, in which everything that's supposed to go up goes down. And that's really capitulation. That's when the race car hits the wall. You're like, dude, you're supposed to be going left. You went straight. Okay, so the big risk on turns into the big risk off. Yeah, and that still might be the case. But if the Fed changes policy, then the timing of hitting the wall changes. So the blood in the streets might be earlier. It might. But I don't know. We'll see, right? We'll see. But when I'm talking about efficient market theory that says you cannot beat the market because everything is already priced into the market. That's like saying everybody is rational. That everybody does what's in their best interest. And we know that most of the time that's true. But then there are periods in which humans do panic. So most of the time, let's say 90% of the time you're rational. And 10% of the time you're irrational. And you have to recognize as an investor, if you want to do well on the long haul, when everybody is dumping good assets for cheap, when the fish are jumping into the canoe, okay, get a second canoe. So I look at the bank stocks and I'm like, I get it. There's a lot of risk associated with what I'm doing. So if I pick a good bank with a good client base, with good profit margins, with good management team, 10 years from now, I'll be laughing because I paid 30 cents on the dollar. I'm proud to own it, you see? So that's sort of my logic there. By the way, it pays me 6.5% a year. Hey, burned. Psst, psst, burned. I just covered my inflation. Now I own the stock and I'm protected against inflation. You're welcome. Huh? Wicked smart, huh? Harvard boy. Anyways, so Euro's doing well, but like things like this, like you're outside the target, that's dead. Noise. Yeah, you have to say noise, Burned. Noise. Noise. Yeah. So anyways, I got to check out this Reg D thing. I forget all the numbers. What is it? Reg D 502. Does anybody know these regulations you're supposed to know? Has to do with marketing a hedge fund, which means you can't market a hedge fund. That's what the rules tell you. Honestly, I went through this whole class at the NFA. I was in Chicago, did this whole class. And what the class says is you can't say anything, do anything, tell anybody. The class said if you're at a cocktail party and somebody says, "Hey man, so what do you do?" You have to make them read 20-page disclosure document and then have them sign a piece of paper that says that they're worth more than $1 million a year before you can tell them. It is 502? Okay. But this idea that I don't want to make it for accredited investors only. I would like to market it broadly. I'd like to do YouTube videos, that says, "Hey, bro, this is a retirement account." Oh, that's why it's on my mind. Okay. One of the things I want to talk about is what happened to the banks and why they failed in this idea of redemptions. And as you probably know, hedge funds have lockup periods. Venture capital funds have giant lockup periods. Like you can't get your money back for years. And there's a reason for that, and it has to do with illiquidity. So if you buy into a hedge fund and a hedge fund buys, a huge swath of private stock for a company that hasn't gone public yet, there's no market to sell that stock. So the venture capitalist has to get in there, roll up the sleeve and guide the investment and guide the management team and grow the company and get the customers and all that kind of stuff, get the next funding and then the next funding, then the next funding. And eventually, in their capital stack, they got to sell it to the public through an IPO. So that is a 5-year process, typically. So you can imagine if you invest into a venture capital fund, you can't just come in willy-nilly in year 2, month 3 and say, "You know what, I changed my mind. I don't want to be a VC anymore. Can give me my money back." They're like, "Dude, no. We gave your money to dogfood.com. And there's a 90% chance it's going to lose all its money. In fact, 95% chance it'll lose every penny you gave us because we gave it to them and they're going to blow it. But there's a 5% chance it turns into $1 billion company. 95% it goes to 0, 5% chance it goes to $1 billion. And you can't have your money back because we ain't got your money. So you have these like 5-year lockup periods, right? You never get your money back as a limited partner. Okay. So anyway, then you look at other funds like a hedge fund, and they might have 3 and 6 and even 12-month lockup periods, which means you cannot redeem your money back. You can't go to the hedge fund that has invested into real estate and said, "You know what? I changed my mind. I want to deploy my capital somewhere else. Give me my 10 million back." You're like, "Dude, we bought apartment buildings with it. We can't give you your 10 million back. We will pay you on schedule. And after a certain period, let's say 5 years, usually like real estate hedge funds, their lockup period is closer to 5 years, because what happens is you roll over mortgages and then you pull out capital and then you pay off all your initial investors. That's typically how that works with real estate investment, right? So you're locked up for 5 years, but all of a sudden on the 5th year, you get the new mortgage, pull out the equity. Now there's a big pile of cash. Now you still have the mortgage, but the renters are now paying the mortgage, and you take, let's say the apartment building, you got, let's say 15% of it is investor cash, 85% is bank cash. Okay. So only 50, so you have triple leverage basically, right? And after 5 years, the apartment building has gone up, let's say 10 or 15%. So anyways, you pull that equity out by refining it. And now you got this equity that is now cash, and you pay all your investors back. And now all your investors don't have any money in the project, or very little bit of money. And the bank is holding, right? All the debt now is on the mortgage and not to the investor. But obviously in the middle of that, an investor can't get out because there is no money. So now the bank is holding the entire debt. The investors have been paid off, but the renters are paying the bank. Okay. 5 years later, you roll over the mortgage again, you pull out more equity, you pay off the investors, and now they have an upside of 20%. But the property is going up in value and you're collecting rent. And maybe there's even a little bit of income to go around as you amortize and depreciate. Cool. But it's illiquid. Okay. And hedge funds that are in derivatives are very similar, or in bonds or long short, because think of it this way. If you're running a long short hedge fund and a client comes back and says, well, give me my money back. That's a redemption. Give me my money back. You're like, cool. Well, the problem is the money is in the portfolio. Now, maybe the portfolio is profitable. Maybe it's not profitable. Maybe, what if it's a derivative and you can't really get out of that derivative easily? So hedge funds typically have 3, 6, and 12-month lockup periods, in which when you request your money, you can only request it at the end of a quarter, let's say. And then once the written request is received, then 3 or 6 months later, they can slowly unwind those positions, hopefully not at a loss, and then give you your money back because, well, you're the investor and that is a requirement according to the disclosure document. So if you're in a hedge fund as a limited partner, not the manager, the investor, and you say, give me my money back, let's say the fastest you're likely to get it is 4 months, which allows the fund to slowly unwind without taking crazy losses. Now, when you look at these banks, what's happened? They've taken deposits, kept some of it in cash, kept some of it at the Fed, and the remaining, which is excess capital, okay? And that's part of the formula, right? You take the excess capital and you convert that into a very, very low risk income producing assets, like a government guaranteed treasury, the safest investment on the planet, guaranteed by the reserve currency and the largest economy in the world. Okay, great. And those investments, say, like Silicon Valley Bank, for example, would buy, let's say, a 10-year T-note, because they owned almost all 10-year T-notes. They were heavy in the 10-year T-note. The 10-year T-note is worth $10,000, and at the end of 10 years, you will get your $10,000 back, guaranteed by the government. Meanwhile, every year you get 1%. Every year you get $100. Now, it doesn't sound like much, but Silicon Valley Bank doesn't have to work for the money. They just collect the $100. So in 10 years, they have $1,000 of free money using other people's money, OPM, right? They use the deposits to buy the treasuries. The treasuries are guaranteed and the income is guaranteed. And so now they're like, they took $10,000. In 10 years, they will have been paid $1,000. So they're definitely profitable. So what went wrong? There's no lockup period. The money that the bank has used to buy the treasury is on demand. There's no lockup, not 3 months, not 3 years. Okay. It's completely liquid. But now, because the interest rate went up on the 10-year T-note from 1% to 2% to 3% to 4%, the price, the value of those bonds went down, 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 down. Well, what's the big deal? If you're going to hold it for 10 years, it doesn't matter. It doesn't matter if you're going to hold it for 10 years. Unless, out of the blue, totally unexpected, because if you expected it, you would have hedged it. Totally unexpected, never in a million years, right? Let's call it the 100-year flood. It didn't flood last year or the year before 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 or the year before. You don't ever remember it flooding in your lifetime, and your papa don't remember, and you're like, hey, Grampy, did it ever flood? And he's like, oh, when I was a kid, it flooded. And you're like, hasn't flooded. It's not going to flood. It hasn't flooded since my grandfather was knee-high to a grasshopper. And then one day it floods. The 100-year flood happens. And the 100-year flood is there's a run on Silicon Valley Bank. They actually want their money back. And they're like, dude, we bought a bunch of 10-year T-notes. Like, if you just wait 10 years, we get the money back. But if you need it today, we're going to take a bloodbath, because the value, if you have to resell your thing, you're going to sell it at a loss. Think of it this way. You buy a brand new car, $50,000. Okay, cool. How much money have you lost in 1 year? How much money have you lost in 5 years? How much money have you lost in 10 years? You don't really know until you sell it. But you don't feel the loss in real time. As far as you're concerned, you still have a $50,000 car, right? But you know over time it's losing value. Now, the only difference is that you've bought the car for $50,000, and for whatever reason, in 50 years, it's a classic. What if you were guaranteed, if you to keep in good shape for 50 years, it'll be worth $50,000, right? No, whatever. I'm stretching here, but you see what I mean? Like, with the bond, you are guaranteed to get your $10,000 back. The only way you can lose money, because you know you're guaranteed to get your $10,000 back, and you're guaranteed to get paid your $100 a year, because you bought it and it only had a coupon of 1%. It's all guaranteed. The only way you can actually lose money is sell it before maturity. And that's the problem. Redemption. Redemption song. The song of bankruptcy is what I never need. Yep. Redemption song. So anyways, they get crushed because now their $10,000 asset they're selling for $8,000. Okay. So anyways, I want you to think about this idea of liquidity. Banks have to remain very liquid, so they do pay you an interest on your deposit, right? But it's minuscule. Now, if you invest into a hedge fund, if you get paid at all, you get paid huge, but you invest into something completely illiquid. And very often, intangible. Well, you own dogfood.com. Well, what is dogfood.com? Well, we have a website, and we have a logo, and we have an all go. You're like, dude, what is that crap? Oh, it's like ones and zeros sitting on a computer somewhere. It ain't real. Okay. Now, the next step is you might invest into real estate as a hedge fund or, let's say, a syndicate, right? And the cool thing is you can make and lose money, but the thing is you can go visit your apartment building. That's actually Crypto saved me. That's really funny, huh? Fed Marley and the Baylors. That's really funny. Well played, sir. Well played. I love it. Everybody says, well, no, it's not a bailout. If you said it's not a bailout, then it's a bailout. Adam's like, classic case of bad management. Yeah, but the thing is, what I was saying here is, when there is a small window of inefficiency, when efficient market theory, okay, EMT breaks down, then your alpha is your ability to find the needle in the haystack. Which one of these things should, right? Like, in fact, here's what you're doing. You're reaching into the haystack that's on fire to pull out the golden ring. Okay? Which one of these things should not be burning? Okay? The ring is gold. It kind of looks like the straw. Hard to find this ring. Big pile of straw and it's all on fire. So your job now is to be the one that has the cash, has the liquidity, and has the wherewithal to find the bank that shouldn't be on fire. And you're like, no, there's nothing wrong with this bank. So if you want to sell it to me for 70% off the high price, well, shoot, I'm willing to take that side of the trade. While everyone else is panicking. Yeah. And that's the breakdown. And that's where I think in some cases, like if I'm going back to this, you can see there might be sort of like, again, the red is when QuantBox is saying the economy is not doing well and you should be more of a bear than a bull. Okay. Now, obviously you're using technical analysis with this. At some point you stop selling. Okay. And then at some point you start buying, right? And in this case, economically, you should be buying euro and selling CAD. Just comparing the interest rate differential, the unemployment differential, inflation differential, GDP differential, technical trends, seasonality, retail sentiment, COT data, scoring them and all that kind of stuff. And right? And knowing which side you should be on. Because there will be at points, always there will be points in which technicals disagree with the economic data, but the economic data isn't wrong. Ever. It's quantitative. You can add it up. Okay? There are 7 strawberries and 4 blueberries. If you have a computer doing the math, it will never get it wrong. But you might want the blueberries. Well, that's your sentiment. Why do you want the blueberries? I don't like strawberries. Okay, they make me burp. I don't know, but you're right. So there's a behavioral thing. You might find that the blueberries are worth 10 times more, and you're like, oh my God, I haven't had blueberries in so long. They've been so expensive. I'll take the blueberries every day. Well, once again, behavioral. But the number of blueberries and strawberries, you'll never get wrong. Ever, 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 ever. Okay? So that's why you need technical analysis as well. And that's why part of that technical analysis is included where QuantBox is actually looking at the technical trend. Not to the degree you're looking at. It's identifying trend. You might be identifying pullbacks to buy trends, and you might buy or you might do technical analysis to identify the potential top and reversal. QuantBox isn't as smart as you in that way. It can identify trend and strength of trend. The trend is speeding up, this trend is slowing down, but you're the smart one. The computers are dumb. Oh, but ChatGPT, well, it will lie to you all day, and if you are uninformed, you're going to believe that crap. A friend of mine, he asked ChatGPT because he was doing research on his family history. And he found the first dude in his family to show up in America. And he wanted to know, well, he couldn't find any data like when was it, what year, what ship did his relative get to America, where did he arrive? Very interesting, right? They searched all the databases and they couldn't find anything. So they asked ChatGPT. And it wrote a full-page article of complete bullshit. Beautifully written bullshit. Your relative, his name was blah, 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 and he arrived on the Mayflower and and it wrote all this out, beautifully written, just bullshit. So, be careful how much you lean on a computer. Do you really want artificial intelligence, or would you rather just be intelligent yourself? Actually intelligent. Well, that's why you need to intervene, and that's why you got to use QuantBox, where QuantBox gathers the data accurately all the time, including trend data. And now you got to be intelligent. It's just organizing and ranking and displaying the data beautifully for you to make a rational decision. You see? And there are times when the market is irrational, and I bet you that's where you do your best. That's kind of what you want. You see? That's your value. That's the value creation you offer. So that might be buying, like I said, knowing that when there's blood in the street, do you know what to buy? Some of you guys ask about the buying when there's blood in the street. Well, you have to know two things. When is the blood in the street? Okay. And two, what do you actually buy? Okay. Cool. I know I hit that hard. Remember, tomorrow's the Fed meeting, so there's only so much you can do. Chasing euro now that it's strong is just a weak hand. You're playing a weak hand if you wait for things to move and then you decide to do something. It's just really weak. Okay. Buying double bottoms off centrals, off of weekly pivot points. And this is a very, very basic swing trade. Okay. So all you had to be, I want to make this point. This is important. On a longer term chart like Euro Kiwi, I'm just looking at this daily Euro Kiwi. I don't really care about this pair. Okay? Although you can see I have a bullish trade here. trade plan. But nonetheless, look, way back on the first of the year, this became bullish. That's that. And since then, you've decided to buy dips. There are two types of dips. One is a dip back into the moving averages. Okay. And then there's price action dips where you're looking like old resistance becomes support, right? Old resistance becomes support. And then inside of that, you have things like pivot point theory. Like the weekly trade plan is buy at M2, exit at M4. You see, like you should be done, right? And then the next trade plan is, and I got to do this in a different color, buy at the central pivot and exit way up here somewhere. But we're done for the week. You see that? We're done for the week. So to see this giant move up today and then buy it is just really weak. I would rather have you told me that you've been a bull on Euro Kiwi all year and you've been buying dips. And these are like weekly pullbacks and then up for a month. Weekly pullback, up for a month. Okay? But all prior. Okay? I would rather you be wrong than chasing price. So this is a good old kick off the 55. And to take it one step further, what that means is you might get to this M4 and then it comes down. The flip side is we all expect Europe to raise interest rates, and we all know that they're paused. So the only thing that could save Kiwi on the short run would be a stimulus package out of China, and this pair goes neutral, where they both become bullish. But you know what? That's actually what the chart says. That we are now going to enter a regime of S1R1. But now you got to think forward, like, oh, what would create that? Oh, well, China boosts that and then offsets that. And that's what the 55 is suggesting. Okay. Okay. But to be chasing Euro today, really? Huh? Really? Okay. Looking at the euro dollar, that's when the market became bullish. This is the 1, 2, 3 daily entry on the weekly central. Here's the pullback to the moving averages. You were probably hoping it would fall a little further, but it kicked off the psych level. That makes sense. But look at our target yesterday. Great. Great. Look what just happened. We've hit today's target already. So I'd be prepared for profit taking, which means you probably will get a dip like this. But if you started buying now because you woke up and you saw this move here, guess what's likely to happen? Another way of saying it is probability. What this chart says is, it's over, it's done, yet. And the only trading will be profit taking. And someone will sell their profitable trade, right? A strong trader will sell their profitable trade to a weak trader who now wants to buy it. Okay? And so that's all. I'd rather you be more prepared, kind of stronger. Okay, we talked a lot last week about hammocks. Was that here or in the swing trading group? I think that was the swing trading group. Does anybody remember if I did it publicly or was that a private training? I can't remember. Okay. I remember some people hadn't heard it before. Richard, what you're talking about is pre-London. Oh, this was swing trading, Adam? So like, that's how you set up a trade like that. And so now, if it's Tuesday and our projection is to hit our target on Wednesday, that is how you do it. That's how you do it. That's how you trade. What it's doing now to me is irrelevant. You're just moving stops, and you'll probably, again, probability, you'll probably get a dip and look at tomorrow's target. Okay? Now, you could carry this a little bit further and say, well, based on this entry, okay, the target is here. Sometimes what I do is I look at my actual entry, which is closer to here, and I call it an M2. I don't call it a central. I call it an M2. So I would go with the conservative weekly target. Okay. You see what I mean? Do 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 do, redemption song. Okay. Yeah, well, that's what's being played. That's what's being played. That's what you see here. Okay. That's what you see here. Ciao. My WTI. Okay, we're approaching a top. A breach would be, I mean, it's already technically bullish on a 1 hour, but a breach higher would be significantly bullish. Okay. Green continuation means bull. Red continuation means bear. So bear, 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 bull, 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 bull. See ya, cash. Cash in, cash out. Okay. What do you think? Obviously, this is going to be an important price today, huh? At this point, you need to declare if you're a bull or a bear. You should have already entered in at 67.87 if you're a bull. And a bear, actually, a lot needs to happen to be a bear. Now, you could just sell at the top, but to me, that's sort of a degenerate gambler trade. You kind of need like down and then up and then down and then up and then down and, you know, somewhere in this area. You become a bear, huh? Yep. Waiting, wanting for you to justify my trade. My trade, for you to justify my trade. Yeah. Yeah. Wanting, waiting, rooting for you to justify my trade. Yeah. Does anybody know who wrote that song? Let's see if you know your 90s history, huh? Who wrote that song? Who won a Grammy for that song? Let's see if you know your 90s trivia. Come on. King, yeah. Who? No, I didn't write it. Nobody knows, huh? You're like, I didn't even recognize it, and you butchered it so poorly. It was written in a bungalow at the Beverly Hills Hotel. I ain't gonna do it. Lenny Kravitz wrote it, and he had hung out with Madonna in the villas section of the Beverly Hills Hotel a couple of times. And he was just writing music to pass the time. And he came up, Justify My Love. And so he had exchanged phone numbers with Madonna. And he called her up and he's like, hey, I wrote a #1 hit for you. And she's like, I'm busy. I'm doing other stuff. And he's like, no, seriously. This is a #1 hit. You need to do this. And she's like, all right, we'll come by the studio and show me what you got. So they recorded it in an afternoon and it became a #1 hit. And he won a Grammy for writing it. Milos nailed it. Yeah, but I already told the story. No, I didn't want to point it out too early, Milos. Yeah, no, I know you got it. I didn't want to point it out too early because I wanted other people to respond. Yeah. Yeah, but he was right. Oh, for sure. You know, you need to know these things, guys. So anyways, so there we are, caught between a rock and a hard place. Okay. XAU coming down, which is really great. Because do you remember I drew a line in the sand? Sorry for those who bought gold and didn't take profit. If you recall, I did point this out. Does anybody remember how long ago I pointed out gold to 2000? Was it down in this area? I know this X is where I stopped selling gold, so I got some profit there. Turned $100 into $250. Ain't bad. Okay, and now there's a bit of capitulation because of tomorrow. The thing is, are you RWA in the future? Do you have a plan already for tomorrow? Burns says it wasn't far with Madonna. Well, the obvious answer was Madonna. I mean, it was the #1 hit that Madonna sang. It's on Madonna's album. Yeah, anyways. So I want you to, guys, I want you to think about this. It's all about tomorrow. Have you gone through your charts and developed a narrative for what you're going to do tomorrow? Can you sit down and explain it to somebody what you intended to do tomorrow and why? When you're a hedge fund manager, how often do you think you have to talk about what you intend to do in the future and what you think is going to happen in the future? Burns says, I won't do anything tomorrow. But you know what? Tomorrow's the key point. So you should be prepared today for tomorrow, Burned. Okay? You can do some analysis. And if you can get into a trade and move your stop to break even before tomorrow, maybe you get lucky. Not because you're a degenerate gambler, but because you did research and you entered in your trade based on what you think will probably happen. And then throughout the day, maybe you can reduce your risk by moving your stop closer and closer to break even. And then tomorrow, boom, it comes out just like you thought. You don't get any negative volatility because you were entered in early and you survived that initial burst of vol. And all of a sudden it takes off just like you thought. Paid. Because you were in early. You see? That's what's going on these charts, by the way. Meta's like waiting on API today. Yeah. Yeah. API doesn't come out till the end of the day, though, huh? So, well, Burned, the issue with tomorrow is the volatility. And it's not necessarily trading tomorrow. Very often it's portfolio adjustment and stop loss management. Okay? And so that's where you get like, you know, the crazy up and down is because some people are entering trades, some people are exiting trades, and then some stops are hit, and then some limits are hit, and then other people are freaking out, and other people are jumping in, all of which is not necessarily good for your health. So I'd rather you be in on Monday, Tuesday, or before Wednesday. You're in the trade that you think you want to be in, and you already got your stop at break even. So, hey, man, you never know. It will probably go your way if you've done your fundamental research. Now, Jay Powell might come out and say something completely different from what your research suggests, and you don't get creamed. You get knocked out of break even. You're like, dang it, Too bad, so sad. But you got a free look at the basket, so you took a shot. And that's your job. Or Jay Powell comes out, says exactly what you thought, and boom, you're up 250 pips on the day. Nice. But you didn't trade Wednesday. But you did trade. So like in the day trading group and the swing trading group, all we talk about, as you know, is the future. We talk about tomorrow, the rest of the week, the next month, the rest of the quarter, next quarter. We're always thinking ahead because I want you to be in those trades before the trades actually happen. So again, like looking at euro dollar and euro strong today, an amateur trader is going to buy it and lose money. Because it already happened. So what's going to happen next? A smart trader that was in yesterday will sell that position to an amateur trader that now wants in. Well, guess what? That's what profit taking is. Right? So anywho. Just trying to, I'm not saying I have all the answers. I'm just saying everybody needs to think ahead. That's our job. That's our value creation. So a friend of mine who runs a hedge fund, he's in Japan right now talking to banks and hedge fund investors. Huh? For his raise. He's doing a capital raise, right? A cap raise. Great. Sweet. How much do you think they ask about past performance? Oh, a bit. Sure. But it's usually like 2 questions. And then how much do you think they ask about the future? Probably 10 questions. Because when a hedge fund manager's answer is, well, I've lost money for 5 years in a row, they don't go on capital raising meetings, right? So instead, it's kind of assumed. Okay, what's your rate of return? What's your Sharpe ratio? I need a risk-adjusted report performance so I understand what you're doing. Okay, great. What kind of strategies do you do? Oh, we have strategy A, strategy B, and strategy C. Okay, good, understood. Done. That part of the conversation's over. The rest of it is, who are you and what do you think? And so they want to know your past, and then they want to know the future. What do you think? What do you think the Fed's going to do? What do you think about the ECB? What do you think about the Bank of England? What do you think about emerging markets? What do you think about the bond market? What do you think about Silicon Valley Bank? What do you think about this? What do you think about? 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 I don't think about anything. I just trade the MACD. Oh, great. Well, have a good one. And you just lost your client, right? Yeah. See, people want to know what you think about. So Richard is on target. There are 2 things that could happen. Powell comes out and says that they're sticking the course, which supports the dollar. Or if they mention the word disinflation and sell the dollar. Okay, maybe. I would say that is somewhat true. But the missing component, I believe, Richard, is that they raised by 25 basis points. It's already priced in. We all know it. So that's not news. So I would discount all of that. It's not wrong. I think everybody already knows that. So we'll get the number. Great. Fine. The surprise will be if they don't raise. That would be an earthquake to the financial market. So that's not going to happen. Okay, that would be a financial tsunami, earthquake, volcanic eruption, and an asteroid hitting the planet all at the same time. It's not going to happen. Now, people like to go on TV and talk about it because it's good for ratings, but it's stupid. That ain't going to happen. So and they're not going to raise by 50 because it would show that they're so unbelievably out of tune and out of touch with reality that they're negligent. So that ain't going to happen. Okay, great. So they're going to raise by 25 basis points. That's all. Okay. So that's already baked in. So what you said is correct, but there's only like one likely result out of that, which doesn't really help that much. Okay. So now the next step is they raise by 25 basis points, but they release a summary of economic projections. Ho, ho, ho. So I'm not even going to pay attention to this statement. I'm going to go straight to the SEP. And I'm going to go straight to the dot plot. And if it goes up from 5.1 to 5.3, as I said 2 weeks ago, I'm going to buy the dollar. If it stays at 5.1, I'm going to sell the dollar. Ooh. Whoa, dude. Dude. I know, right? Smart. As they say in Boston, smart. Wicked smart. Cool. The next thing is Powell in the press conference or in the statement or in both comes out way dovish. Way dovish. And basically tells the market that a pause is likely and a cut is maybe. Sell the dollar. Sell it even if the SEP goes to 5.3. Remember, most people aren't smart enough to even track the SEP. But if Powell comes out dovish, by the way, one of my books coming out is called Hawks and Doves, just so you know. But anyways, if Jay Powell comes out dovish and says, well, you know, this is a real threat and we have to take it in consideration. You know, this is a real systemic risk. Yes, our rate hiking cycle is part of the problem. And all of that gets construed into there's a pause coming soon in the first half of the year and a cut coming in the second half of the year. And then, oh my God, Becky, sell the dollar. Okay. Now, can I get a thumbs up for that? I mean, come on. I did all the voices. I made it funny, but I think I also made it clear. I think I just demonstrated that some thought was put into this. Would you be willing to click the thumbs up button for that? It's not bad, right? Entertaining, educational, informative, actionable, witty. Little humor, little charm, Canadian grace, eh? Yeah. Come on now. Kick down, come clean. Don't be a holdout machine. Cool. So, if you are a member of FX Bootcamp, there's a video membership, there's a swing membership, and there's a day trading membership. All three members. I'm going to put together a live stream tomorrow, not on YouTube, at FX Bootcamp. So a whopping $88 a year gives you access to this special event and the others that I've done so far this year. Okay. So I invite you to swing on by, be a member of FX Bootcamp. I swear to you, your $88 will buy you at least $888 of value, at least. I would even argue more than that, but let's just put it 10x. The best $88 you'll ever spend in your entire life if you're a serious trader and investor. Cool. Is that a good sales pitch? That's it, and I'm not even joking. Okay. So I will see you later. Oh, members of FX Bootcamp, if you're in the day trading group or the swing trading group, remember you have the stop, look, and correct session at 2 p.m. And then you have, if you're in the day trading group, you have the day trading group with me at 4. So this is one of those busy days. If you're a member of FX Bootcamp, there's so much going on. It's a hell day. It's so much work. But it's the value that we're offering. So anyways, so have fun today. And you'll see Ryan at 2, and then you'll see me at 4 here at Romper Room. Bend, stretch, reach for the, how does it go? Stars. There goes Jupiter, and there goes Mars. Bend, stretch, reach for the sky. Stand on tippy toes, oh so high. Cheers. Pachow. Hey, that just happened.